Hello viewers. Intro and thesis, I have always been skeptical about long-term investment in Chinese companies, mainly due to concerns about the VIE structure and the authoritarian nature of the CCP, which I believe hampers China's growth prospects. These concerns kept me from upgrading Alibaba Group, NYSE, Baba stock in the past. See my detailed coverage history, even though I saw obvious signs that there should come an upswing. Well, first, we saw the co-founders Jack Ma and Joe Tsai had bought a lot of Baba stock in their personal portfolios. Second, my outlook has become even more positive on the extreme cheapness and overbought conditions of the entire Chinese equity market. Today, however, I believe that Baba could be facing a number of serious problems, primarily related to profit-taking by speculators and the ongoing macro problems in China. Why do I think so? The rally in Chinese stocks was actually a direct response to a series of economic stimuli from the Chinese government. The once fast-growing country began to experience typical problems of developed countries, such as an aging population and youth unemployment. So the People's Bank of China, PBOC, decided to take unprecedented measures. As my friend Okoff Investments summarized it in his Veil article, the new stimulus focus intensified in mid-September and culminated with a package of measures. Reductions of 50 pp's and 20-30 bps respectively in reserve requirement ratio and borrowing rates on tenors by the PBOC, and support to the capital market by the state. The latest Politburo meeting, headed by President Xi, accompanied by his closest aides and trusted assistants, made a pledge to support the property industry and boost fiscal spending, as China now wants to reach the official growth target of 5% for the year. Those measures triggered a big move in Chinese assets, CraneShares CSI China Internet ETF, KWEB, reaching highs it hasn't seen since early 2022. Some analysts, like those from UBS, said this policy shock had renewed expectations that China's growth story might turn the corner. They now expect fast policy easing to support short-term confidence in Chinese stock valuations, ultimately leading to further gains for markets. And the stimuli announced may be far from what investors should expect, as China has room to ramp up fiscal support for the economy by issuing as much as 10 trillion yuan, $1.4 trillion in special debt, according to Bloomberg. In this context, it's not at all surprising why Alibaba, as one of the largest and most well-known Chinese companies out there, has experienced such strong growth over the past few weeks. On the other hand, this surge appears to be driven primarily by macroeconomic shifts, rather than any direct financial improvements within the company itself. We know that in its fiscal 1Q FY 2025, calendar 2Q FY 2024, Alibaba reported below consensus sales, plus 4% YOY, with core China retail sales declining slightly year-over-year. EBIT dropped by 15% to Ys with 35,989 million RMB, equal 4,952 million sois, mostly due to the absence of a significant reversal of share-based compensation expense that had bolstered the previous year's results. Adjusted EBITDA slightly declined by 1% YOY to $6.2 billion, reflecting relatively good operational performance despite the challenges. On the other hand, Q1 Baba's net income to ordinary shareholders was down 27% in net income. The fall was driven by declines in income from operations and increased impairment of investments, partially offset by favorable mark-to-market volatility in equity holdings. However, Alibaba's non-GAAP net income declined by only 9% to some 40,691 million RMB and $5.6 billion. So with massive repurchases, the non-GAAP diluted earnings per ADS of 2,026, 5% YOY, was enough for the firm to show an EPS beat for the quarter amid all the challenges. The Cloud Intelligence Group saw 6% revenue growth to $3.65 billion due to strong public cloud development and use of AI products, as the management explains it. But in my view, this growth rate is still lagging far behind the Western peers, like Amazon's AWS, AMZN, or Microsoft's Azure, MSFT, as it was the case in the past few years. Baba is set to continue investing in AI and cloud to retain its market dominance in the region and seize new opportunities in data science and machine learning. But I think that its global presence isn't going to be as massive as some bullish-minded investors are hoping for. Be that as it may, there is a ray of hope in the company's segments. Alibaba International Digital Commerce Group, AIDC, reported an astounding 32% increase in revenue to around $4 billion, as efforts to increase efficiency and expand its supplier base are bearing fruit. And I think this trend will continue in the coming quarters. Also, Cainiao Smart Logistics Network and Local Services Group both experienced solid revenue growth thanks to the integration of e-commerce business and higher efficiency. Alibaba was struggling to stay as profitable as it was someday through shifting markets. The company's net cash generated by operating activities was $4.6 billion, a 26% decrease from the year earlier in RMB terms. Free cash flow, an important liquidity indicator, shrank 56% to $2.4 billion due to increased capital spending and working capital movements. So the free cash flow, a key point of discussion among bullish investors who have cited it as a primary reason to buy Alibaba stock, was shrinking significantly in fiscal Q1 FY 2025. This is due to the company's substantial investments in its cloud segment, which is not growing as rapidly as some competitors. It's crucial to understand this context. Nevertheless, Alibaba remains one of the most active companies in share buybacks. Management believes the stock is undervalued. Consequently, they continue to actively repurchase shares available on the market and have substantial authorized buyback plans to do so going further. However, it's crucial to understand why the shares were valued at a discount. If you examine the company's growth rates over the past period, you'll see that they have generally remained consistently low, not only compared to Western peers, but also to Chinese counterparts. It's clear to me that new incentives from the Chinese Communist Party could potentially boost the Chinese economy and possibly lead to a rebound in Alibaba's business growth rates. However, competition remains intense, particularly in the cloud segment, which continues to lag behind in the market. So from the fundamental perspective, I believe the stock may have already experienced enough significant growth, capturing much of its potential upside. The company's valuation has deteriorated considerably over the past few months, even though its key multiples remain among the lowest compared to similarly sized companies. Additionally, the Morningstar rating, proprietary source October 2024, suggests that the recent Baba rally has exceeded the fair value estimates calculated by their model. As a result, I don't see strong potential for growth at current levels in the short to medium term. What I believe is that we are likely facing a significant correction at current levels, as the Chinese stock market appears to be more overbought today than ever before. No matter how hard China tries to boost the economy and its real estate sector, fundamental problems such as the aging population and youth unemployment will likely persist. As Ray Dalio has noted, China may face a more serious problem than Japan did in the 1990s, and this issue is unlikely to be solved by fiscal or monetary stimulus alone, in my opinion. Therefore, taking into account both company-specific fundamentals and general macro conditions, I conclude that while Alibaba's stock can continue to grow given its recent rapid rise, as such explosive growth typically doesn't end abruptly, I believe that the upper limit of growth potential that I had previously identified has now been fully exhausted.